comes into the picture now. 89.86 is currently where the currency stands. 89.95 was the intraday low, inching closer to the 90 to the dollar mark, marking a 35 paise or a 0.4% fall today. The reasons continue to be the negative sentiment from the FPI outflows. The RBI is believed to be supplying dollars, but in modest amounts. Latha is here with more on this. Latha.
Well, first the numbers, 89.50 overnight and now 89.95, so pretty close to the 90 mark, about a 40 paise fall or a 0.4% fall. Could become even a 0.5% fall. The slide is, the reasons are not new. The reason why the rupee has been the worst performing currency and why it has fallen with some accelerated pace since mid-November are both the trade deficit and the capital outflows, the capital account deficit. From November 18, the fall has accelerated because that day we realized that the October trade deficit is $41 billion, which means the US trade deal is now beginning to bite. The fact that the trade deal was not signed all through November has kind of accentuated tensions or at least worries within the exporter-importer community as well. And those who have open positions or those who had to buy dollars, importers, are now rushing in to buy, which explains the accelerated fall in the rupee. What we hear from dealers today is that the Reserve Bank doesn't appear to be supporting any level. It is just, graduating the fall so that probably a market-determined cheaper rupee will correct the current account deficit, the trade deficit to some extent. It will make the Indian exporter more competitive and it will make imports more expensive and thereby protect domestic industry. So it's just allowing the rupee to find its level, but only graduating that fall. An important positive that many dealers pointed out, or at least a few dealers pointed out, is that it's not the Reserve Bank alone which is supplying dollars. Closer to the 90 rupees per dollar mark, even exporters, others are supplying, giving the impression that the market itself feels that things have gone far enough. So the hope is that around the 90 mark, the rupee will have seen a bottom, at least for the near term. But who knows, I could be speaking too soon.
Latha, thank you for that update there. Still closer to the mark of 90 to the dollar is where the currency stands. Earlier, we did speak to some experts on the slide that the rupee has seen, and we also asked them about a possible impact of a trade deal with the United States on the currency. Listen to what they had to say.
I do think 90 is very much on the cards for the rupee. Look, I think the biggest factor is us not having a trade deal, at least by the expected timeline. Now, there's a whole lot of uncertainty as to when the trade deal would happen, which means that not only a future economic growth is at risk, of course, we are also experiencing a widening of the current account deficit. Capital flows remain deficient. So all of that points to an adjustment in the currency, which is also warranted from an economic perspective. I therefore do think until we have a trade deal and we know its fine print is actually favorable for India, the rupee should continue to weaken at a moderate pace.
I'm not seeing, there's a lot of expectation about the US trade deal getting done, and that's sort of getting built in. And that's the reason rupee is not really flown. So in case there's any negative news, then I think you can really see a spike. I was also talking from a technical angle. I think because it's already breached the all-time lows, the rupee, I think it has a potential to go anywhere between 90 and 92. I'm not saying it's a done deal, but it's a probability which I will lay almost 60-70% weight on that.
I don't think that the rupee in itself is the dominant driver of the interest rate decision. I think that, if you recall, even in February, earlier this year, when the rupee was close to or had just breached 88 levels, the RBI, went ahead and started its rate cutting cycle. So, I do believe that while, yes, rupee volatility, rupee pressures are important, I don't think that they are the dominant factor. I think that the RBI, the upcoming policy, will perhaps focus more on assessing what is happening to domestic growth, not just in terms of what has happened so far, but also perhaps be a little bit more forward-looking. Try and assess the implications of US tariffs since we still don't have a trade deal. I don't think that the rupee in itself is the dominant driver of the interest rate decision. I think that, if you recall, even in February, earlier this year when the rupee was close to or had just breached 88 levels. The RBI, went ahead and started its rate cutting cycle. So, I do believe that while, yes, rupee volatility, rupee pressures are important, I don't think that they are the dominant factor. I think that the RBI, the upcoming policy, will perhaps focus more on assessing what is happening to domestic growth, not just in terms of what has happened so far, but also perhaps be a little bit more forward-looking. Try and assess the implications of US tariffs, since we still don't have a trade deal.
Shifting